Thank you. Good evening, friends. Welcome to this excellent webinars which we do every Friday and every Saturday. And today's webinar, we will be discussing about AS 109, Ind AS 109. And Mr. Venkat Subramani will be teaching that Ind AS like a junior KG student. I have learned that from him. So he makes the subject so simple, which otherwise the whole world feels it is very complex. So we are very lucky that he is with us. The similarity between him and me is that his first initial is R and my first name initial is R. And he qualified in the same year, 1983, when I qualified. And he's an encyclopedia, moving encyclopedia on IFRS and Ind AS. And we have a second session where Mr. Vishal Podar, the name itself is very big, Vishal. He will be telling us on input tax credit, which is very important. Tax saved is tax earned. How to minimize the GST tax liability. And we have Dr. Salim Khan who will be moderating. Now, the objective of these webinars when we started on every Friday by the Committee on Economic and Commercial Law and Economic Activity, and on Saturday by Continuing Professional Education Committee. And we have a very excellent team of officers. Like today's webinar is coordinated by Madam Chanda Sukla and Mr. Krishna Kant. And we have a technical support of a very best technology company of the world. Now, we want each member to be a thought leader. Thought leader means like Mr. R. Venkat Subramani is a thought leader on IFRS. When a topic of IFRS comes, if somebody any company want to install a platform for converting financial statement into IFRS or implement IFRS, Ind AS is another name only of IFRS. See, this terminology should not confuse us. Accounting standard, Ind AS, IFRS. The double entry bookkeeping was invented by a mathematician, not by an accountant. So there was an Italian mathematician, Luca Pacioli, in 1494 who invented that. So each one of us, God has given unlimited power to understand any subject, to begin from at any stage. Because what is in our hand is today and a time after just now. So for past should be always celebrated. We should dance on our past because whatever we did, it was perfectly 100% right. There was nothing wrong in our past. So I want members to come out with ideas, write to us on which subject they want to become a global practitioner. The committee, myself, has unlimited time. And we will mentor one-to-one to each one of you. You can come forward to become moderator. You can come forward to become a speaker. There is a scheme where we encourage writing. And there is a small amount we pay 500 rupees per page. So if I write, say, 200 pages, I am awarded 1 lakh rupees. Plus the book will carry that. Book is contributed by CA Dr. Rajkumar Adukia. So seeing our name in a print document, in the digital form or in a printed document, has more life value. I consider that as a more life value. That also has a value because the video, the recordings is put on the digital platform. So the three clauses, clause 6, the clause 5, 6 and 7 in the first schedule, securing the work, soliciting the work and advertising the work, do not affect any way when I talk about my knowledge on all the medias, Facebook, LinkedIn, Insta, Twitter, website, online platform, and n number of other social media platforms. So please extensively use, and the best way of saying that I am an expert, like Mr. R. Venkat Subramani is an expert on IFRS, is to share the knowledge rather than saying I am expert. And by that the work comes. So I'll stop here because we need more time to listen R. Venkat Subramani sir. And Dr. Salimji, his talk itself is an introduction, so we will save time. And right. Maybe Vishal, or you can carry on. Let us.
Exactly.
Yeah. Salimji, over to you.
Sure. So this was Dr. C.A. Rajkumar Adukia Saab. And because he has suggested we'll save more time, we'll have more sessions, we'll learn more about him. So we'll move down to C.A.R. Venkata Subramani. He has taken out his valuable time to discuss with us about today's topic. He's a chartered accountant with over 3 decades of experience, really vast experience. He's engaged in IFRS and he has clientele across the globe. He's currently handling several NBFCs and he holds diploma in IFRS from UK, ACCA. He's an India rank holder in both CA and ICWI. That's really hats off, sir, to you. He's a visiting faculty in the Institute of Chartered Accountants of India. And he also takes certificate course for the last 6 years. He has authored many books and volumes on etiquettes, futures and options, accounting for investments, fixed income, etc., etc. So we are moving ahead to see R. Venkata Subramani. So please enlighten us with the expanse of knowledge that you have and let us know, especially in this COVID-19 situation, where your topic is going to be really, really helpful to all our friends from the fraternity over here. Please carry on, sir.
Thank you, sir. Thank you. Thanks both of you for your very, very generous introduction about me. It's always a pleasure to be as part of this CA Institute's lectures, wherever it is. I really love, because this is a place where I get a lot of qualitative inputs. So every time I take a class, I actually learn. So it is not the other way around. I actually learn from them. So it's always a pleasure to be with this very, very erudite professional colleagues of mine. So thanks once again for being here with us on this Sunday evening. So let us move on. See, the topic that we're going to discuss today is about the expected credit loss. Now, this expected credit loss is something that is new to all of us. So it is new to all of us. All of us as accountants, I would say. As an accountant, this is new to us. But as a banker, if you were in banks, probably this is not that new to you, because you would have already dealt with in the form of the Basel requirement, as to how we need to compute the expected credit loss. Having said that, there are very, very subtle differences between the expected credit loss as required under the Ind AS and as computed as per Basel laws, as per Basel requirement. We're not going to go deep into this. So the idea is to give you a very, very conceptual overview. I just want to start with a very, very interesting observation, which is, when IFRS 9 was finalized, in 3 separate installments. Okay, they came up with 3 separate installments, one in 2009, then in 2010, 2013, and the final installment came in 2014. 2014 talked about the expected credit loss. So that was the time when the standard setters who are sitting on both sides of the Atlantic Ocean, namely IASB and FASB, both these standard setting bodies agree to disagree. So, which means that the expected credit loss as per US GAAP is slightly different from the expected credit loss as per IFRS or as per Ind AS. I mean, just to by way of an introduction, to say that we are not going to deep into the compare and contrast the expected credit loss as per both, but just to keep that in mind that these two accounting bodies have different interpretations of ECL. Now, what is this animal all about? This expected credit loss. Now, here there are certain very interesting observations which I want to make here, that there is no specific model or method that is prescribed in the standard. So this is purely principle based. You know, all of you are very much aware that IFRS itself is completely principle based, as against the counterpart, the US GAAP, which is rule based. But then when it comes to ECL, it is completely principle based. There are only indicative things as to how to compute, but there are no rules that are there. So which means that the good news is that you don't have to be a PhD or a Nobel laureate in order to compute ECL. What is required as per the standard is a very simple model. And I always used to say that this model should pass the common sense test. So if it passes the common sense test, that is good enough. It has got to be completely transparent and it should be consistent. Now, when I say consistent, we need to follow more or less the same model and the methodology year after year. So this is now seems to be a very serious requirement. The reason is because the regulators perceive a change to be a mechanism whereby you try to manipulate your profit, so to say. I mean, manipulate is a slightly a harsh word, but what I wanted to say is that more like a profit smoothing. So you should not use this ECL as a sort of a profit smoothing mechanism. So that is the reason why they are extremely careful that this has got to be consistent. That does not mean that once you define a model, once you pick up a model, it has got to be something that is cast in stone. No, that's not the idea. The idea is that you can always calibrate it. You can always calibrate it progressively depending upon the data availability. Again, ECL is something which requires, it is completely data intensive. So you require a lot of data, and this data may not be available. So if this data is not available, then you will have to slightly compromise on the model so as to do the best thing, whatever is possible with the data that is available. But then as and when you have the data, you get the data, you can keep calibrating that model in order to get the best result. Okay. There are multiple methods, there are multiple methodologies, there are multiple models that are there available. Some of these things are, like a transition matrix model, which is also known as the Markov chain model, the discounted cash flow method. Then you have a specific model based on the transition matrix for project loans. And for receivables, it's a completely different model. It has got nothing to do with the model that you use it for a loan portfolio, because for receivables, you have to apply what is called as a simplified model. Now, again, I want to give you a little bit of word of caution that the schedule 3 to the company sector today, as far as it refers to the entire gamut of all the companies under Ind AS. Now, there is a specific requirement as to how you need to compute the ECL. You have to compute the ECL for receivables. I have heard some of the professional colleagues stating that you don't need ECL for receivables, but that is not true. We have to compute ECL for receivables as well, as per the simplified methodology that is prescribed in the standard. And the disclosure standard, the disclosure now is required for specifying certain key points as far as ECL for receivables itself is concerned. Now, that is just an introduction. Now let us see. I just want to give you a sort of a bird's eye view about ECL. Now, this ECL, in short, can be defined as the present value of cash shortfalls. In fact, this is the way it is defined in the standard itself. present value of cash shortfalls. Now, let us get into the definition a little bit further. So, cash shortfalls is the contractual cash flows less expected cash flows. So you have the contractual cash flows on the one hand, and based on certain events that may or may not occur, your expected cash flows are likely to be different. So you need to find out the difference between the two, and that obviously is known as the cash shortfalls. Now, you need to take the exposure at default and multiply it by the probability of default, multiplied by the loss given default, adjusted for the discount factor, which is you have to take the present value of that, and that in an essence is the expected credit loss. This is at a very, very high level. Let us dive deep into each one of these components, okay, to get a better idea. So the ECL is present value of cash shortfalls. What is the present value? Present value is based on the EIR, which is the effective interest rate. So you compute the effective interest rate of the particular financial asset we are talking about and find out the cash shortfalls, which is the contractual cash flows less expected cash flows. Apply the EIR on this one to get this. Now, EIR is the EIR as per Ind AS. Now, contractual cash flows less expected cash flows can be converted into a formula. Now, this formula is not defined in the standard, but it is given by way of an illustration. Illustrative examples make use of this formula, which is exposure at default multiplied by probability of default multiplied by LGD. Let us dive deep into this to understand each one of these terms. Exposure at default is the outstanding amount plus that which is the principal amount plus the interest. So principal plus interest is their exposure. Probability of default, there are multiple ways to compute the probability of default. We will see a couple of ways to compute this probability of default. Then loss given default is defined as 1 minus the recovery rate. So what is recovery rate? Now, when a borrower takes a loan, the borrower most likely is required to give some sort of a collateral. So if the loan gets defaulted, then the lender has the option of selling off the collateral and try to recover whatever is possible. So 1 minus that recovery rate is your loss given default. So recovery rate is calculated as the collateral minus haircut. So depending upon the nature of the asset, like or nature of the collateral, say for example, if it is gold, then probably the haircut will be only 5% or 10%. But on the other hand, if it is land and buildings, then probably the haircut could be as high as 40%. And if it is equity shares, it may be 50%. So you will have to apply a proper common sense to find out what should be the haircut that should be applied on this one. So collateral as reduced by the haircut divided by the exposure gives you the recovery rate. So that is your 1 minus recovery rate is your loss given default. So when a default occurs, the loss that can arise on account of that default is defined as the loss given default. Now this is at a very conceptual level. Now let us see what the new requirements. Why this? Now here, previously we had a model which is called as the incurred loss model. So the loss was recognized, the loss on account of the not being able to recover a loan. So that is the loss is recognized based on the time when it is incurred, so which is called as the incurred loss model. Now that is what is replaced with the expected credit loss. Now this model is forward looking. Now as accountants, you will immediately raise your eyebrows and say, okay, why do we have to do something on a forward looking basis? We never do that. As far as accounting is concerned, accounting is purely historical. So we don't consider any projections for accounting purposes. But this is one place where we do consider a sort of a projection, so to say. So you can say this is the historical loss as adjusted or fine-tuned or calibrated for the macroeconomic scenario. So the macroeconomic data will reveal the macroeconomic scenario and how it is going to impact your future collections, the collection. So that is what is called as the forward-looking macroeconomic data. So this is now to be adjusted for forward-looking data. And this model is applicable for all the financial instruments, for all financial assets. So the same impairment model is applicable. There is no different model for different types of assets. So these are in a nutshell, the new requirement for this impairment model. As far as the scope is concerned, well, the scope is, it covers all financial assets. It covers debt instruments measured at amortized cost, which is quite obvious because these debt instruments at amortized cost are never fair valued, because you only consider what is the current amount that is recoverable as against the amount that is recoverable after some time. So which means that this debt securities that are measured at amortized cost. But then even those debt securities which are measured at fair value through other comprehensive income, that is which are classified as FVOCI, are also subject to this impairment model. Now you may ask, why is it so? Because the asset is already valued on a fair value basis. So does it not include the loss on account of expected credit loss? No, the answer is no, because the default loss is not considered there. What is considered is only the interest rate changes and so on. So you will still have to apply the expected credit loss for FVOCI classified debt securities as well. Then loan commitments, financial guarantees, which are not measured at FPTPL, and lease receivables. So all these lease receivables and contract assets, trade receivables, all of those things are subject to this impairment model. So what is out of scope is equity instruments and the loan commitments that are measured at FPTPL. Now this equity instrument is now deliberately out of this impairment model, okay, for very conscious reasons. Now let us take a look at the overview of the impairment requirements. Now every financial asset is supposed to undergo these three stages. Okay, I mean, it can undergo these three stages, not that it has to undergo, it may undergo these three stages. Stage one is when it is a normal asset. So that means you are able to collect the dues regularly. So that means there is no question of any increase in the default risk and so on. That is what is called as stage one. But then when the credit risk increases significantly, it moves from stage one to stage two. So now there is no specific definition in the standard as to what is meant by significant increase in credit risk. There is no such definition, but then it has a rebuttable presumption that if the number of days past due is 30 days and above, then it means that it automatically moves to stage two, or in other words, it means that the credit risk has increased significantly in respect of these assets. And then it finally moves to stage three when the credit risk increases. The credit risk increases to the point that it is considered as credit impaired. That means already it has become impaired, or the standard makes it a rebuttable presumption that if the number of days past due exceeds 90 days, then it means that it is already impaired or it is already defaulted. Now, fortunately for us, this is the same yardstick as what is used by the banks for defining what is called as an NPA asset. So NPA assets are the ones where the default DPD, or the days past due, is 90 days and above. There is the same yardstick that is applied, unless you want to have a rebuttable, you want to rebut it with concrete reasoning as to why you want to consider it as not having been impaired or not having been defaulted, even though the days past due is 90 days and above. So that has to be done on a case-by-case basis. Now, let us see these two definitions once again. One is SICR, which is significant increase in credit risk. You can see the color that is amber here. That means, it's a sort of a just before danger. Red is danger, so it is already defaulted. So it is amber, where the credit risk has increased significantly. There is no definition in the standard, but what is to be considered is whether the risk of default has increased significantly since the initial recognition. Now, this requires a little bit of explanation. Now, let us assume that the entity has obtained two financial assets. Okay, and both these one of these asset is rated. The credit rating of one of these financial asset is say A, and the credit rating of the other asset is say C. Then, on the date of valuation, that is on the date on which you close your books, whether it is on a quarterly or an annual basis, both these instruments are rated C. Now, as far as the first instrument is concerned, the first instrument, the original rating was A, that was the rating at inception, and the current rating is C. So, since the initial recognition, the rating has substantially reduced. So, in other words, the credit risk has substantially increased because it has fallen by 2 notches. Whereas the second instrument, the second financial asset, it was rated, the credit rating was C at the time of initial recognition. Now also it is C. So that means the credit risk has not increased since the time of inception. So that means as far as the second asset is concerned, SICR has not happened. Whereas as far as the first asset is concerned, SICR has happened. That is, there has been a significant increase in credit risk, even though both these assets are credit rated at C on the date of valuation. So it is not the absolute rating that matters, but the relative rating as compared to what it was at the time of inception and what it is today at the time of valuation. That is what is significant and relevant. Now, as I mentioned to you, that there is a rebuttable presumption that the credit risk on a financial asset has increased significantly since initial recognition when the contractual payments are more than 30 days past due. So DPD, if it is 30 days and above, then automatically it means that it has gone to stage 2, or you can say that the significant increase in credit risk has occurred on this particular asset. Now, for default, there is no definition. Each entity has to define what is meant by the default, but it should be consistent with what is used for the internal credit risk management purposes. So the entity should also see the qualitative indicators like breaches of covenants, all those things have to be considered. And finally, there is a rebuttable presumption that the default does not occur later than 90 days. So if it is 90 days and above, it means that the particular asset has already defaulted. Now this credit impact, so we will go through the various factors, okay? Because this is the essence. Now I'm trying to cover the whole thing in 1 hour, which normally takes about 5 to 6 hours to complete. I'm trying to complete it in 1 hour. So I just want to give you the essence without compromising on some of the details. So I'm going through all the details, but at the same time, I want to give you the overall picture, and that is the objective. So these are broadly, I will say, are the steps that anyone should follow as far as the computing ECL is concerned. The first one is what is known as segmentation. So you have multiple loans. You should first segment those loans into portfolios or sub-portfolios, whereby you aggregate this based on the common risk characteristics. So group all these and then classify into appropriate segments. Now, this is extremely important because if it is not grouped, if it is not segmented, then your probability of default will be not representative of the population. So your probability of default you will have to compute individually for the different segments. So in fact, I have examples to prove that if the segmentation is not correct, then for the same set of data, you will get different answers. For the same set of data, if you do not segment it properly, you will get different answers for different segmentation. So segmentation is extremely important. So the second one is the methodology. Okay, we will go through one by one. So segmentation. So the examples of segmentation is it could be by instrument type or credit risk ratings, collateral type, data financial recognition. There are so many methods by which you can aggregate those loans which share the common risk characteristics or shared risk characteristics should be grouped together. Now, the one word of caution here is that you cannot have so granular segmentations which will defeat the very purpose. So that means you cannot say, okay, I have about 1,000 loans, and I want to classify it because I think that each one of the loan is completely different from each other. So I want to classify it as 1,000 different segments. Now that again you will be losing the vital information. So you have to group it. So the grouping should not be so granular. The grouping should not be at a very, very gross level. So you have to have an appropriate level of grouping. Very, very important. The second one is there is no specific method. So as I explained to you earlier, Ind AS 109 does not prescribe a specific or mechanistic approach to assess the changes in the credit risk. So the appropriate approach will vary for different levels of sophistication of the entities. That means depending upon the type of data or availability, depending upon the level of data and the reliability of the data that is available, you will have to tweak the approach. Now, many people come and ask me, can you suggest a model? So I'll have to say to them that, I can't suggest the model unless I know what is the level of availability of data with you and what is the reliability of such data. Just because data is available, you can't rely. You have to apply certain statistical principles, statistical tests in order to find out whether such data is reliable and so on. So again, the use of the term probability default occurring was intended to capture the concept of risk of default occurring, credit risk. Okay. Now let us move on. Now this is one method. So I told you there are multiple methods for finding out the probability of default. Now, one of these methods, which according to me is very simple and it is highly transparent. It has got several advantages over the other black box approaches, because I am not an ardent fan of a black box approach. Okay, even though it you try to impress someone by having a black box approach, but it's not going to impress the regulator. The regulator wants to see a very transparent model. It should be easily understandable. And this is one particular model which, according to me, has a lot of benefits, a lot of advantages. Okay, so here this model, this model tells you to track every loan as to how it moves from one period to the other period, how the loan moves or behaves. You are trying to find out the historical movement of the loan, of each and every loan from one period to the other period. So, for example, if an account in the current state this month will be in the current state next month, if the payment is made by the due date, and it will move to the next bucket, which is 30 days past due bucket, if no payment is received. Now, this is such a simple fact. I think all of you understand this fact very, very easily, but it's such a simple fact. But then this simple fact carries thousands and thousands of volumes of information. the entire model is based on this particular fact. So the transition matrix here represents the period by period movement of the loans between delinquency classifications or states. So we can easily classify this based on 0 days, then 1 to 30 days, then 30 to 31 to 60 days, and so on. So these buckets you can classify, and you can track each individual loan to find out the historical performance of such loan, how it has moved from one period to the other period, not from one bucket to the other period. Please don't mistake me. How it has moved from one period to the other period. So whether it has remained in the same bucket or whether it has actually improved, it has gone to the previous bucket, or it has become worse by moving to the right side, that it goes to the next bucket, and so on. Now, so this, based on this, finally what you get is like this. So I'll just go to the output here. So each and individual loan is analyzed and it is tracked. So what you see here as the this column, and these are the rows and these are the columns. So this columns, how it moves from one period to the other period. Now this number of observation is plotted for each and individual loan. Like that, all the loans are taken and it is also plotted. Then finally, you sum up all those things and convert those observations into percentages. Now this becomes your probability of default. Now, this probability of default is time sensitive. What do I mean by this? It is time sensitive because here we are tracking the movement from one period to the other period, which is 30 days. So that means every month we are tracking. So which means that this represents the movement of the loan from in a period of 1 month. So how it has moved from 1 month. But what the standard wants is, the standard wants to have a 12-month default probability. So this, which means this represents only a 1 month default probability. If you want to compute the 12-month default probability, you have to raise this transition matrix to the power of 12. So this is done by what is called as a transition matrix multiplication. So you have to do a matrix multiplication. So you have to raise this transition matrix to the power of 12 in order to get the probability of default for 1 year. So use that probability of default in the first equation which we saw in the beginning. Okay, so that is how this PD is computed. Now, this PD, as I told you, there are several ways. So this transition matrix method, which I just explained to you, is based on the historical method. That is one. You can also use the transition matrix, which you get from the credit rating agencies. Now, these credit rating agencies like CRISIL or ICRA, they publish what is called as the credit transition matrix, which is an open source. You can just Google it and find out. So they publish the transition matrix, and you can also use that transition matrix to compute. Normally, this is used for the project loans, which are large loans given to big organizations which are already rated. Now, the transition matrix method is used for even for larger organizations, but that is on account of these smaller loans given to several people. So you may want to group it and then compute the transition matrix. That is the first one. The second one is for larger loans for the credit rated companies. Then you have a roll rate method and flow rate method. So flow rate method is normally what is used for the receivables part. That is for the trade receivables, you normally use this flow rate method. Okay. Now, LGD, I already explained. LGD is 1 minus recovery rate. So you find out what is the recovery rate. To find out the recovery rate, you need to find out what is the collateral and find an appropriate haircut. So collateral minus haircut, then you take this collateral, the present value divided by the exposure will give you the recovery rate, and 1 minus recovery rate will give you the loss given default. Then you need to also make use of the forward-looking macroeconomic indicators. That's what I told you first. Now, this macroeconomic indicators, there are, if you Google, if you are a paid subscriber to say Bloomberg, or for that matter, for Economist Intelligence Unit. Okay, this EIU, which is an economist publication, that gives you about 300 macroeconomic factors, for every country. So if you're doing it for an Indian entity, then you have, say, for example, you have the GDP growth rate, you have unemployment rate, you have the inflation, you have the risk-free rate. You have like that the house purchase index. Like that, you have about 300 macroeconomic factors. Now, all of these macroeconomic factors may not be relevant. So what is very, very important is that you need to find out that there is a statistically acceptable correlation between the receivables data, which is your loan data, which is also known as the dependent variable, and the macroeconomic data or macroeconomic factors, which are known as independent variables. So you have to run a multivariate regression test. This test you need to do in order to find out whether there is any statistically acceptable correlation. And only if it is there, you will have to make use of that particular macroeconomic indicator. Just because the indicators are available, you can't use that. So these are the steps. And the reason why we do this is because the standard wants you to create at least 3 scenarios, a minimum of 3 scenarios you need to create. So there is a scientific method by which you can create these additional 2 scenarios. So what is that method? That method is, first get the loan receivables snapshot for the last several periods. Like say, for example, for the last 5 years, monthly data, or 5 years quarterly data, whatever is relevant, whatever is available, make use of that. And that is known as the dependent variable. Similarly, get the macroeconomic data for the same period. Then run a multivariate regression. After you run this, you have to ensure that if the statistical test passes, that means your R squared should be above a particular number, which is about, say 60 or 65. And p-value should be less than 0.05. So these are some of the statistical requirements. So based on that, you have to iterate the variables and find out which one passes a statistical test. Once the test passes, then make use of the intercept and the slope and find out the projected value. This is obtained by applying the equation y is equal to mx plus c, where you have the intercept and the slope. Intercept is c, slope is m. So you make use of this formula, this equation, to find out the other 2 scenarios. So this is just a snapshot I just want to explain to you. So here you have the data point dates. This is the valuation dates in March 21, and you have the GDP, inflation, and display rate. So I'm trying to find out whether these 3 macroeconomic factors have got any relevance. Should I use these 3 macroeconomic factors or not? Now, for this, I make use of the snapshot of the percentage of loan or the receivables that are not yet defaulted. So these are normal loans. So this is what is called as a dependent variable. The other 3 are the independent variables. Now you run this one, and you run this multivariate regression analysis. And if you run this, then you will get here, you will get the intercept, you get the intercept and the slope. These are the slopes of these 2 variables. So you get the intercept and slope. Somebody. Okay.
We have a few questions coming up. So, I will just in between, if you could just answer them, it will be really great, sir.
Yeah, sure. Okay. Now, intercept and slope, based on this, you find out. Okay. Now, I want to provide some time to take the questions also. Okay. Now, so based on this, the resultant scenarios, so you find out what is the percentage. So this is your expected increase in default or decrease in default. Decrease is minus is decrease. So you expect in the next quarter, the default is going to be decreased by these 2 percentages. So one of the things I want to tell you is that, this is not See, these two scenarios, please don't confuse these two scenarios with the stress test scenarios. Because, I know many people confuse this with stress test. No, this is not a stress test at all. So these are the two scenarios which you are expecting this to be a possible outcome. Okay. So what it means that these additional scenarios need not necessarily be an optimistic scenario or a pessimistic scenario. Both can be optimistic, both can be pessimistic. It will be decided by the macroeconomic data. You are not going to decide this. So in this case, it so happens that both these scenarios are favorable scenarios, which means you are going to expect, your expectation is that your default is going to come down in the next quarter. Okay, fine. Now, so I just want to talk to about this probability weighted. Now, three scenarios minimum. You can have more scenarios, more the merrier. So here I'm assuming that there are 5 scenarios, and you assign probabilities, and you also find out the ECL for each scenario. Find out the probability weighted scenario, probability weighted ECL. So here in this case, 2362 will be your answer, which is your probability weighted expected credit loss. But then one particular scenario in this case has a probability of 40%, and the ECL is 2,000 rupees. So this is the most likely outcome. Now, as far as US GAAP is concerned, under US GAAP, 2,000 will be taken as the ECL, because there what is required is the most likely outcome. Here what is required is the probability weighted outcome. Just to tell you the difference between these two. Okay. Now let us look at this model scenarios, how it spans out. Okay. So the model scenarios, you have the base scenario. So you have the computed PD already, whatever you have computed PD. You apply this formula and apply a probability. So this probability of 40% is based on what? It is based on your common sense. It's a judgmental call. This 40% is a judgmental call. Based on this, you arrive. Then you agitate the PD. So which means based on the macroeconomic scenarios. So you agitate the PD and then apply a probability of that to get the second the scenario, and finally again agitate the PD to arrive at another scenario, apply a probability for that, and assign that. So the total thing, you will get this total ECL as per the model scenarios is this. Okay. Now I will take 5 more minutes to complete this whole thing. Then we will take the questions. Right. So this COVID, fortunately, we all believe today the COVID is completely over, because in most of the states, including Maharashtra and Tamil Nadu and several other states, the COVID restrictions are removed. So which means we all believe that the COVID has gone for good, and hopefully so. So, but so long as the COVID impact may still be there, so even though COVID has gone, the COVID impact on financials may still be there for some more time to come. We don't know. We'll have to wait and see. So what are the two impacts? According to me, the two impacts are: one is increase in PD due to reduction in earning capacity of the borrower. The second one is substantial reduction in the realizable value of the collateral. So you may want to tweak adequate or create adequate scenarios called COVID scenarios, taking into account these two factors. So you can create this. And once you have this COVID scenarios, which is also normally called as management overlays, because these are not part of the model. Model, you can't anticipate a COVID in a model, because the COVID is something that happens once in 100 years or so. So there could be some other black swan event that can come up later, but we can't foresee such an event. So these are called as black swan, and such events are normally carried out by management overlays. So here with the COVID thing, what you do, you create additional scenarios and assign a probability for that particular scenario. Similarly, create another scenario. You can have as many as you want, depending upon what factors you want to consider. So in this case, I'm taking 3 scenarios and I've assigned 3 different weights, namely 50, 30, and 20. Now, this is what is called as COVID scenario output. Now, we already have model scenario. We already have the model scenario output. So what you do, you call this as an outcome and apply the regular model parameters to get the model ECL, then apply management overlays to get the COVID-19 parameters to COVID-19 ECL, then apply probably equal percentage or equal weight to these two to arrive at what is called as the total expected credit loss. Now, I just want to add one final thing before I conclude, which is recently the Reserve Bank of India has come up with a particular guideline on 12th of November 2021, wherein they have mentioned the criteria for determining the NPA is slightly tweaked. So in a nutshell, what it says is that you can't treat a particular loan as regular, and if once it reaches NPA, unless all the installments are completed, so the balance is 0 days past due. So it should become 0 days past due. Only then you can treat it as a regular or stage 1 asset. Now, the question that is asked is, should this norm be considered for the purpose of calculating ECL as per Ind AS? Okay. Now, the answer for that is no. At least our view is that the answer is no. So the revised NPA classification criteria does not alter the credit risk. So ECL is computed based on the impact of credit risk. So the principle-based Ind AS prescribe the guidelines. So based on this, you continue to do. So you don't take care of this RBI's guidelines for this one. So this was our call, which we gave for the last December 21 valuation. But then, fortunately, in February, RBI came up with a clarification and they reiterated the same stand as what we took. Namely, they said that as far as Ind AS is concerned, do not take the revised NPA guidelines for calculating the ECL as per Ind AS. So this is what they said. So but then what we did was we took this RBI thing as sort of another scenario. So we said that, okay, so regular model parameters, including COVID, is one outcome. Then the second outcome is the outcome as per RBI revised NPA classification. Calculate the ECL based on that and assign a probability of 25%. Then you get the probability weighted average of both these. So we are doing justice to the RBI revised NPA classification as well. Okay, so I think with this I just want to conclude this one. Now I am open to take questions if you have. Please feel free.
So you'll see the questions in the chat box over here.
Yes, I'm opening it. Okay, I got one question. Okay, dilution of 138 Negotiable Instrument Act and its effect on ECL. Okay, now see according to me, the answer will be the same as what we took for the RBI guidelines, the revised RBI guidelines for NPA. So this one, according to me, will not affect any, will not have any effect on ECL as per Ind AS. See, Ind AS ECL is completely principle based. Okay, role of CIBIL in ECL. Yes, of course, that is a factor that will be considered for ECL. CIBIL score will definitely be considered for ECL. Yes. Yes, it will be considered. So is there a cutoff at which it becomes mandatory for receivables? There is no cutoff. ECL is mandatory for receivables, trade receivables, no cutoff. If you have receivables, you have to compute ECL. There is no two ways about it. Now regulators are viewing it very seriously. So this has also come out in one other report. Okay. I don't want to expand beyond this. But what I can tell you is that it is mandatory. ECL is mandatory for trade receivables, because there is a prescribed schedule. There is a prescribed form also that is given for that. How do we rely on past projection as last year's under COVID has disrupted normal flow? Yes, of course. These are all judgmental calls. So your question I can't answer directly, because if you are talking about the trade receivables, you take the historical performance of the loan, then we take a sample period. So that sample period should be in such a way that it is representative of the reality. Okay, so to what extent it should be considered, what extent it should not be considered, it's a judgmental call to be taken by the ECL specialist, ECL consultant, so to say. Does the moratorium in COVID-19 period has affected? Yes, it has affected ECL calculation, but now it is not relevant, because those period is already gone. That is only from 1st March 2020 to 1st September, 30th September 2000, 30th August 2020. So that 6-month period is already gone. So it did affect the ECL calculations at that point of time. Now it's not relevant. Is it wrong if weightage to macroeconomic factors is not considered in ECL model? Okay, see, the one thing, please don't use the word wrong, okay? Because according to me, there is no right or wrong answer here, okay? So if you can compute ECL as per whatever you want. You will have to articulate your reasoning, and it should pass the common sense test. That's all, okay? So there is no, it's not a science, there is no right or wrong answer here. So it's an art, in the sense that you have to ensure that you are able to properly articulate your stand to the auditors as well as to the regulators. So long as you're able to do that, I think there is no right or wrong answer. So is it wrong if weightage to macroeconomic factors is not considered? Weightage to macroeconomic factors, see, there is no. It depends. It depends. So there's no right or wrong answer. So you have to consider macro. I have told you the principle. The principle is that macroeconomic factors should be considered. It should be considered only if it has a statistically significant impact on your receivable performance. If it does not have, then according to me, we should not be considering it. Right? So, for example, you are. I don't know. You are. In some industry which has got nothing to do with oil price. Okay, that is understood. I'm not able to get any immediate example. So you are in an industry which has got nothing to do with oil price. So the oil price has gone up. So is it going to affect your ECL? No, it's not going to affect. So just find out only those. So how will that be found out? That will be found out by running a multivariate regression analysis. So when you do that, then you will know whether the changes in the macroeconomic factors have got any change in the dependent variable, which is your historical performance of your loan data.
So, sir, thank you so much. These are the only questions. In fact, if there are more questions coming up, the viewers can go through your business card over here, and they can even connect to you. I would request the viewers, if you have any more questions, you can directly mail to CAR Venkatasubramani, and I'm sure he will be very enthusiastic in replying the same to you all. So very nice session. There was one question which I put across on civil, and I was two-minded on that. And you really cleared it for me, because it's an external body and it has no association over here. And very nicely answered. And I'm sure the other participants, the viewers who put across the questions, they're also equally satisfied. I thank you so much, sir, for enlightening us, especially taking out time on weekends when you're busy with your other obligations after, having a lot of work throughout the week. So we'll have the next speaker over here.
Thanks a lot. Thanks for the opportunity.
Lovely, sir.
Thank you.
Lovely, lovely, lovely. So we have the next speaker over here, CA Vishal Podar, and he looks young and enthusiastic, and from his facial expressions, I see he's really excited to move ahead with the session. You're really looking great, sir, and I'm sure this will inspire the viewers also to be more engrossed and involved in your session. So, CA Vishal Podar, he has completed his chartered accountancy in an early age of 21. I just read it, and I could just figure it out before reading it across. He's a postgraduate in commerce from Pune University and a member of the Institute of ICAI. He has been empaneled as a GST trainer by ICAI for undertaking GST related trainings. He's a regular speaker with industry forums on budget, etc. He has conducted more than 500 sessions and more than 100 webinars on GST. And he was a guest of honor at Nasik GST Department GST Day function. He has received National Awards Distinguished GST Trainer in 2018. Now, he's here to talk about the input tax credit, which reduces the tax liability of a registered person. Here, the main propeller for driving through ITC is CA. And we'll see how Podar Saab takes it ahead. Sir, all on to you. Please go ahead.
My pleasure. My pleasure. Good evening, all the members. And thank you very much, the CP committee, for according me this superb opportunity of interacting with my members. And thank you, Salim Khan, sir, for your very wholehearted welcome and also my nice introduction. So let me start with my PPT, sir. I would request your input, sir, in between. If wherever you feel I need to stress upon something or I need to take a pause or something, you can just please help me with that, sir.
Sure, sir. I would just suggest if you keep on looking at the chat box, so it will be more convenient rather than disrupting you in voice.
Okay, or should I take it at the end, sir?
At the end would be absolutely fine. Last Perfect. 15 minutes.
Perfect.
Please go ahead, sir.
So, dear members, now we are into the 5th year of GST, or I'll say the closure of 4th year of GST and the starting of the 5th year of GST. And I'm sure the most troubled thing in GST after registration and after filing of returns would be the heart, the soul of GST, that is the input tax credit. Now, today here, I would like to share my views on some very critical issues and also would also like to share my understanding on how you can counter these wherever you are faced with notices on any of these pointers. So let me just take ahead my presentation. Just a second, please. Yeah. So let me take you ahead with my presentation. Now, before I start with my presentation, it is my normal practice that I try to link whatever I learn with the subject at my hand. And also I try to link it with our culture. Now, in our Indian philosophy, we all have this concept of Trideva. Interestingly, in the Western philosophy, Trideva is also present in the form of God. When we use the word God, we always have been groomed to believe that God is the name given to the Almighty. Sorry, I beg to differ. According to me, God is nothing but the abbreviation given to the Indian philosophy of Trideva. How? G stands for generator, that is for Brahma. O stands for organizer, that is the Vishnu. And D stands for destroyer, that is Shiva. So, in the Western philosophy of God, what exactly is addressed is our own Indian philosophy of Trideva. Now, how this philosophy is related to our subject of taxation? In our subject of taxation, the role of Brahma, the maker, is of the parliament. And in case of GST specifically, it is also the council. Then comes the role of Vishnu. It is played by we, the consultants, and from the government side, the departmental officials, where our role is to ensure the proper, smooth, and efficient implementation of the law created by our Brahma, that is the parliament. And then the role of Shiva, the destroyer, is played by our judiciary, where since GST is still in a very nascent stage, it is very important to correctly interpret and wherever required, even strike down the wrong provisions or the provisions which are not in uniformity with the actual theme of the subject. So this role is played by the judiciary, and we see so many high court decisions where some of the provisions of the law have been either struck down or have been properly clarified. Now, with this background, let us start with our deliberation on the ITC issue. Now, my major focus would be addressing the litigative part, as I also mainly practice into consultancy and litigation. And day in, day out, I always, whenever I'm on any forum of the members or of trade bodies, I'm always put across these questions, and majorly the questions are thrown on the subject of ITC. So I've compiled all of my observations and understandings and opinions, and we can take ahead this point. Now, the most important part when we are fighting for the ITC is whether ITC is our legal right, whether it is our constitutional right, or it is merely a benefit or concession given by the parliament and given by the law. Now, to understand this, let us go to the statement of objects and reasons. When GST law was introduced, the 122nd Constitution Amendment Bill and also the GST bill, when these were introduced, the statement of objects and reasons of this bill, both the bills rather, very elaboratively clarified that the basic purpose of GST is to remove the cascading effect, and this could be achieved by a seamless flow of the input tax credit. Hence, input tax has become the soul of the GST law, because until and unless input tax is properly passed on from one dealer to the other, the basic intention of GST, that is removing the cascading effect, giving the benefit of value added, will not be achieved. Hence, the law proposes in its objects that there would be an inbuilt mechanism to ensure that there would be no cascading effect, and that would be achieved by the sole concept of input tax credit. Now, this is what our statement of objects have spelled out very elaboratively. Now, what are the constitutional provisions? So, since when we are fighting any of the litigation, many times in the court of law, we have to answer this. My personal view is that when we read the Constitution right from the beginning, originally there was an article 19(1)(f), which had given us a constitutional right on our property. However, this article has been deleted from the Constitution by way of the 44th Amendment Act passed in 1978, and in its place, a new article was introduced by the same Amendment Act, Article 300A. Now, both these articles spell out the rights relating to property. And now what is important is, where the earlier Article 19(1)(f) gave an open right to us, 300A has restricted that right, which says that you will have right over your property, but save as provided by the law. It means you will be having right over your property, but subject to the provisions of the law. Now, what impact this has? Before I go to the GST cases, let us start with the legacy decisions that we got in the pre-GST era in the form of excise, VAT, and service tax. Now, some remarkable decisions are, the most common one which we apply even in the GST law is of the Eicher Motors. In this, the law has made two things very clear. First, it says that you will be entitled to credit, provided it should be on the basis of the existing scheme, that is the existing mechanism of the law. However, once you follow the existing mechanism of the law, whatever is provided in the law, that is, you satisfy all the conditions and the requirements of getting the credit, after that, it becomes an indefeasible right. And then in future, the government cannot deprive you of this or lapse this particular credit. Now, this is a landmark decision which we use even today, and where it could be used in the GST law is this. If you all are well versed with the textile sector, you would be knowing that in the year 2018, the government allowed refund for inverted duty structure to the textile, but with the condition that whatever credit they have as on 31st of July 2018, they are supposed to lapse it. However, this particular notification passed by the government has been struck down by the Honorable Gujarat High Court in Shabnam Petropils, where it has relied on the decision of the Eicher Motors that once you satisfy all the conditions for getting the credit, that is the credit as accrued to you as per the law, it becomes your indefeasible right, and later on, by no change or amendment in law or by no notification, it can be taken back. Further, you can apply this in the concept of blocking of ITC, where your ITC has been blocked as per Rule 86A of the CGST rules. Further, many times it so happens that, especially this would have happened in the initial years, that while availing credit, you avail the credit under the wrong category. The invoice was correct. The supplier levied the correct tax. He did not make a mistake in levying the tax. He levied correct CGST, SGST. However, when you are punching in your returns, you punch it as IGST or vice versa. Now, if you have to fight out that case, again, you can use this particular case law as your defense. Next is, there is another provision is relating to time limit of availing ITC provided in 16.4. We can even fight out that time limit case using this particular decision, how I have elaborated in my further slides. Also, in section 18, there is a criteria that you can avail ITC only of last 1 year. You can even defend that particular point using this case law. So this Eicher Motors case has brought to light two important points, though it was of the excise era, but it can very well be applied to the GST era also. One, it says that you will be allowed credit provided it is as per the provisions of the scheme, that is of the law. You have to satisfy the conditions underlying it. And second, once you satisfy the underlying conditions, after that, it becomes an indefeasible right, and then no one can take it back from you. Further, the next landmark decision in this case is of Godrej and Boyce. Again, in this also, it has underlined that very basic point, which we also found in Eicher Motors case. That is, that it is nothing but extension of the benefit of set-off, and it itself is a boon or concession. So Godrej case has spelled out very clearly that it is not a right, it is only a boon or concession. Next is another landmark decision of Daiichi Karkaria. We apply this in many cases relating to input tax credit issues. Again, what has been pointed out is once you make the necessary declarations, that is what were required in the earlier excise regime, once you file all those returns and make necessary declarations, then you have a complete command over your ITC. Similarly, in Jayam Company's case, it has been clarified that the law, whenever it grants a concession, it can always put some underlying conditions which have to be strictly complied with. And once you comply with those conditions, then only you are eligible for that concession or right. Further, in Karnataka value-added tax matter, it has been again very clearly spelled out by the Honorable High Court that how much credit, under what circumstances, all these are in the rights of the legislature to decide that how, when, how much they can allow you the credit. Now, similarly, we have some judicial decisions, pronouncements even in the GST era. First, very important one is of the VKC footsteps, where it was again relating to the inverted duty structure refund, where we were contesting that we should be allowed credit of even input services. However, the Honorable Supreme Court has clearly said that you will be allowed only of inputs because that is how the scheme has been designed in the law. Similarly, in RSPL Limited's case, it has been again clarified that you will not be eligible to avail credit of capital goods. In specific case, here it was a transitional credit issue. And in the Mohit Minerals case, now Mohit Mineral case is there for some other reason also, and the decision of the Honorable Supreme Court is pending. But as far as this point is concerned, it has spelled out that credit of clean energy cess, which you were supposed to pay in the earlier regime, cannot be set off against the compensation to state cess, because again the law does not provide so. Now, from all these pre and post judicial pronouncements, what analogy we can draw about ITC, that whether it is a right or it is a concession? So first thing is that as on today, there is no specific provision either under the Constitution or under the GST law which will give you a 100% right over ITC. That is, it is not giving ITC the color of a constitutional or a vested right. Further, Section 155 of the CGST and the SGST Act imposes burden of proof on the person, that is the buyer. Whoever wants to claim that he is eligible for ITC, it is upon him to prove the eligibility. Hence, we can conclude that. Now, this is the most important part, that ITC is not a fundamental or constitutional right per se. Underline, it is not a fundamental or constitutional right now, as on today, because of the amendment in the Constitution. And it has been also continued in all the decisions in the pre and post GST era. So it is not your constitutional right per se. However, once you satisfy all the underlying conditions which are provided in the Act and backed by the rules, then it would become a constitutional right. So the answer to this first burning issue on ITC is that whether it is a right or a concession, the answer is it will be a concession until the day you satisfy all the underlying conditions. Once you satisfy all the underlying conditions, then it could be said to be your right, and then nobody can take it back from you. So this is my first submission and my first sharing of my understanding on the point of whether ITC could be termed as a right or a concession. I hope this point would be clear with all. I'll just see if there is something in the chat box on this. No. So let us proceed. Still, if you have anything, you can put it in the chat box and we can take it wherever it is possible for me, either in between or towards the end. Now, I go to the CGST law in particular to understand what are those underlying conditions which will make ITC your indefeasible right. So let us start with the provisions. Now, we all know that the major point of conditions allowing ITC is covered under section 16. And I'm sure if you go by the verbatim of section 16, it starts with a non-obstantive clause, section 16.2, which put down these conditions. Now, what are these conditions? 16.1 requires that you should be registered. 16.2 requires that you should possess the valid document, which could be tax invoice, debit note, etc. Then, most important, the amendment which was brought last year, but which has been implemented or which has been notified to be effective from 1st of Jan 2022, that is this year, is that you will be eligible for credit only when it reflects in your 2B. Now, this point was amended or it was introduced in the form of 16.2AA in the last year itself. However, it was not notified. It was introduced by the previous Finance Act, but it was notified to be effective from 1st of Jan. Now, why I'm stressing on this point? Because my later discussion would be having a good reference to this particular point. So please bear this point in mind. Next important requirement for getting ITC is you should have actually received goods and services. Further, you should claim it before the due date. You should have filed the returns. You should have made payment to your vendor within 180 days. Now, all these are your responsibilities. What is the responsibility on the vendor? The vendor should have paid the tax. Next, in some cases, which are provided in section 17, the credit could be blocked. So your credit should not be falling in that 17.5 list. And as per 17.2, in some cases, you would be allowed credit only of the proportionate amount because you are engaged in both taxable and exempt supplies, etc. So these are the basic conditions. Now, with these conditions as a backdrop and specifically this amendment, let us understand what are the current critical issues in your ITC matter and how you can handle them whenever you receive a notice or you go into litigation of any of these pointers. Now, the first point is section 16.2C requires that you will be eligible for ITC only when your vendor has deposited or paid the tax with the government. If your vendor fails to pay the tax, then you will be denied the ITC. This is what is the basic criteria of 16.2C. Now, we all are facing so many notices in relation to the 16.2C matter. Now, in some of the cases, genuinely, the vendor is a fraudulent person and he has fled with the tax and he has not deposited with the tax. But in major cases, what we are handling day in, day out, the vendor claims that, sir, I have deposited the tax. I am honest taxpayer. However, due to portal issue, either it was not able to be reflected or in the initial 19 years, we all were not well versed with the portal. So the vendor has committed some mistake by putting it in B2C instead of B2B, by putting wrong GST number or by committing some error, which later the portal did not allow him to correct. And this has happened with many of us because the portal usage was very much new to us and we all were very nascent as far as the portal usage is concerned. Now, despite of the vendor giving a written declaration to this effect and producing all his returns to prove that, sir, I have deposited the tax, still you are denied ITC on the ground that since it is not reflecting in your 2A, 2B, it means the vendor has not paid the tax. Now, when you are charged with this particular point that the vendor has not paid tax, then what is your defense? For this, Firstly, section 16.2 reads like this, that subject to provisions of section 41 and 43A, now 43 has been removed, the tax charge in respect of such supply has been actually paid to the government. Now, this is the requirement that you will be allowed ITC provided this happens. Now, if you receive a notice where your vendor claims that, sir, I have paid the tax, and there is no fraudulent practice from the side of the vendor, or even if the vendor has not paid the tax. Now, this is important. Even if the vendor has not paid the tax, but you were not a part of this particular fraud, that is, you were unaware of the intentions and the behavior of the supplier, then you can very well defend your case. How? These are certain pointers that you can put in your reply to these notices. One is lexit non cogit impossibilia. Now, this is a Latin term, a legal term, which means that you cannot be called upon to do something which is impossible, which over here means that whether your supplier has paid the tax or not is outside your control. Now, this particular point has been accepted in many cases. I have quoted one such case over here, which you can always put as a reference. So you do not have any control over the supplier, and putting such a condition that you have to ensure that the supplier has paid tax is impossible. So once something is impossible, that cannot be enforced on you, and it cannot be upheld in the court of law. So you can use this particular point as your first line of defense. Next, even in the 20th GST Council meeting in para 18.3, if you go by the minutes of this meeting, it clearly says that there would be no automatic reversal of input tax credit at the recipient end where tax has not been paid by the supplier. Now, this is what even the council has taken up for discussion, and this is what they have concluded, that there cannot be an automatic reversal at the recipient's end. However, this particular scenario will change because of the amendment brought in by the current Finance Act, which has also been passed. However, let me inform you, as per this new section 41, it says that if the supplier has not paid tax, you will be required to reverse the ITC with interest, and later on, whenever he pays tax, you can avail the ITC. But this particular Finance Act, even though it has been passed, but the application of this particular section 41, or rather all the amendments in GST law, are yet to be notified. So as on date, this new section 41 is not in effect. Now, whenever it comes into effect, then there is no possibility, but you'll have to compulsorily reverse. But for all the periods prior to the new section 41 coming into effect, you can always take these pointers as your defense. That one, the law clearly provides that you cannot be asked upon to do something which is impossible. Second, even the GST Council minutes of the 20th Council meeting clearly says that automatic reversal is not required. Now, further, to add to this, we have two landmark decisions in our favor. One is of the Arise India Limited case. Yes, it is of the pre-GST regime. However, since the provision of the Delhi VAT and our GST as far as ITC availment is concerned are very much parallel, we can always apply this particular case. So even the Honorable Delhi High Court has accepted this point, and the Honorable Supreme Court has rejected the SLP. It means that it has also somewhere conferred to the decision of the Honorable Delhi High Court that if the seller has not paid tax, the buying, that is the purchasing dealer, is not required to reverse the ITC. The government has to first try to recover it from the seller, and only when it is not possible, then only they can come back to buyer. Also, the most important point pointed out is that where there is no proof of collusion between the supplier and the buyer, that is, the buyer is innocent, the buyer has himself not involved in any fraudulent activity, then simply because of non-payment or default of the supplier, that will not make the buyer responsible for reversing the credit. Further, this will be violative of Article 14. The another landmark decision, which is of the GST era, is of D.Y. Bithal Enterprises by the Honorable Madurai Bench of the Madras High Court. It has again said that ITC cannot straight away be recovered from the recipient only because the supplier has not paid tax, without allowing the recipient to examine the supplier, and also without initiating a recovery action against the supplier. So in other words, similar on the lines of Arise India case, even in D.Y. Bithal's case, the Honorable High Court has said that you are first supposed to take action against the supplier, and also you have to prove that there was some type of collusion between the buyer and the seller. Then only the buyer could be held responsible and punished in the form of asking the buyer to reverse the credit. Otherwise, you cannot compel the buyer to reverse the creditor. Now coming to the next burning issue. This is the issue which I'm sure will go a long way. That is, you are denied ITC on the ground that whatever you have claimed in 3B as ITC is not reflecting in your 2A and now 2B. Now, this particular point gets strength from Rule 36.4. And on the basis of this Rule 36.4 provision that it should reflect in your 2A, now 2B, the law and the officers are denying you the credit. Now, what could be your line of defense? But for this, let us first understand how this Rule 36.4 was introduced. It was introduced by way of a notification without having any legal backing in the Act. Now, this is the first line of defense that we have. But before that, when was this rule made effective? It was introduced and made effective from the 9th of October 2019. So firstly, let us understand and appreciate this point. Before 9th of October 2019, there was no provision in the GST law, whether in the form of any section in the Act or in the form of this Rule 36.4, which required appearance of the ITC in your 2A or 2B. So if there is any matter prior to 9th of October 2019, anyways, there was no requirement of 2A, 2B at that time. So this is your first submission if the matter is pertaining to this date. I've just in verbatim produced what Rule 36.4 says. I'm not reading it out. Now, interestingly, remember this point. If the matter pertains to, if your notice is pertaining to a date prior to 9th of October 2019, you are in a very strong position. The supporting point is circular number 123. The circular has clearly said that the matching of ITC would be required only for the period post introduction of this notification. Now, even the government circular is favoring us. Generally, what I have seen is that officers tend to go by the circulars issued by the government. So now you have a circular backing to this point that at least ITC of a period prior to 9th of October, you cannot compel or you cannot make the dealer reverse the ITC. Now, I will segregate this particular mismatch issue into 3 categories. One is your notice is covering any period prior to 9th of October 2019. You are in the most comfortable position. You can always quote this particular circular. Second is 9th of October 2019, that is introduction of this notification, that is Rule 36.4, up till the notification of Section 16.2 AA, which is the new condition which I explained in my initial slides where I was explaining what are the conditions, that now reflection in your 2A, 2B has been made compulsory. That has been made compulsory via Section 16.2 AA. Now, interestingly, 16.2 AA was introduced by the previous Finance Act, but it has been notified from 1st of Jan 2022. So I classify the notices into 3 categories. One, notices of the period prior to this Rule 36.4, no problem at all. Notices covering the period between 9th of October 2019 till notification of 16.2 AA, that is up till 1st of Jan 2022. I still believe that we are in a favoring position. How to handle this period notices, we are going to discuss in the coming slides. But from 1st Jan 2022 onwards, it is very difficult to fight on this issue. In other words, I personally would recommend that you should comply with 2A, 2B reflection, and only on that basis you should avail the credit in 3B for any period post 1st of Jan 2022. Now, how to handle or counter the notices which is covering period 9th of October 2019 till 1st of Jan 2022, let us discuss. Now, how to handle these notices? First is, even though there is a rule from 9th of October, but you can always challenge it on the lines that rules always require some section as a legal backing. And till 1st of Jan 2022, that is the implementation of 16.2 AA, there is no section backing Rule 36.4. Yes, there was a section 43A, which was added into the law, but it was never notified. So there is no legal backing for Rule 36.4 till 16.2 AA, that is 1st of Jan 2022. In fact, in the 39 GST Council meeting, this point, after a lot of representation from various state bodies from the CA Institute, was taken up for discussion, and it was recorded that the council recommended that in order to overcome this disparity that we are not having any legal backing, they decided to introduce 16(2)AA. So this is another point which you can use in your reply, that the basic reason given for introducing 16(2)AA was to remove this disparity that rule was without a legal backing. So when this itself was discussed in the council meeting and it is there on record, you can always use it as your defense. 43A, which was introduced, was for giving legal backing to 36(4), but it never saw the light of the day. And today, as per the new budget, as per the new Finance Act, it has already been scrapped because now you have 16(2)AA. So 43A is not required. Further, another contention is that whether 3B is a return, and also the original matching mismatching, which was envisaged in the GST law as per section 41, 42, 43, is anyways not in existence because GSTR 3 itself is not in existence. So all these sections were kept on a bench. Now, if these sections which required matching to get the ITC and which required reversal due to mismatch, these sections itself were ineffective because GSTR 2 and 3 were not made effective. This itself shows that introducing 3B was a mechanism of overcoming 41, 42, 43 because the system did not support matching mismatching, and hence the reversal required for matching mismatching as envisaged in these sections will not apply. Yes, from 1st of Jan 2022, you have no choice, but you should comply with this particular provision. Further, interestingly, an explanation has been added by the previous Finance Act in section 75(12), which says that if a supplier has declared some output supply in GSTR 1 but has not paid tax in GSTR 3B, it would be treated as self-assessed tax of the supplier and recovery shall lie against the supplier. Now, this again could be your line of defense even for our previous issue. Now, many times what happens, the supplier has disclosed it in GSTR 1, so it is appearing in your 2A, 2B, but the supplier has not paid tax. This is another scenario of the prior periods, that is 17, 18, 18, 19. For that, you can always take this as defense that because of introduction of this explanation, again, it clearly appears that the intention of the law is to first cast the responsibility on the supplier, that if he has disclosed in GSTR 1 but not paid tax in GSTR 3B, let us first make him responsible for paying the tax. Now, most important, a decision in our favor and of the GST regime is of the Bharti Airtel, where while discussing the point raised in this particular case, the Honorable Court has specifically highlighted this point in its para 46 that the Form 2A is only for facilitation. It is not a legal document on the basis of which any type of decision relating to self-assessment can be based. In other words, it has been very explicitly pointed out by the Honorable Supreme Court in this particular decision that in para 46, you can always use this para as your reference in your notice reply, that the Honorable Supreme Court has clearly spelled out that 2A cannot be the basis for disallowing ITC. It is only for your facilitation purpose, that whether it is reflecting or not reflecting, that's it. Further, you can give reference to all our erstwhile decisions that I have already quoted. Now, these above contentions you can also use when you're replying to all these notices, where B2B was wrongly shown by your supplier as B2C, hence it is not reflecting into it, or tax is shown under wrong head of ITC, I had mentioned at the start, instead of CGST, SGST, you have shown it IGST or vice versa, or tax is correctly paid by the supplier, but wrong data is uploaded by the supplier in GSTR 1 and he could not rectify it because of the portal glitches. So for all these cases, you can use the pointers that we have discussed over here. Let me just go to the chat box. If there are any specific questions relating to any of these pointers. No. So till now, I have discussed 3 points. One is a generic point, whether ITC is your right or a concession. Then specific points. One is how to counter cases where your supplier has not paid tax, or that is what is the allegation by the department. Second, how to counter the cases where you have received notice for reversal of ITC because it is not reflecting in your 2A, 2B. Now I come to the third issue, which is a very sensitive issue, that is blocking of ITC. Again, by way of a rule, directly by way of a rule, the law requires that the commissioner or any officer appointed by the commissioner or empowered by the commissioner would have right to block your ITC for a period of 1 year. Now, how to handle this particular scenario? To understand that, let us just go to the rule 86A. What it says: conditions of use of amount available in electronic credit ledger, the commissioner or officer authorized by him in this behalf, not below the rank of AC. If the person is having reasons to believe. Now, your first line of defense is asking the department to prove the reasons to believe. Yes, if they are having genuine reasons to believe, fine. But many times, I have seen in many of my cases that many times the department only on their personal choices or their personal decisions without having any material in hand, just because the respective officer felt so that he should block your credit, or he just felt that you are a fraudulent taxpayer. It was only as per his personal wish or judgment, without any legal backing, without any material or evidence at hand. You can always challenge his action of blocking the credit, because this rule, even though if we accept the rule, still requires that they can do this only if they have reasons to believe. What they have reasons to believe? That the credit of input tax, which is available in your credit ledger, has been fraudulently availed or is ineligible. Now again, when they are alleging that there is fraud, they have to prove the fraud. Because once they are alleging fraud, it is their responsibility to prove it. So again, you can take this particular stand that they are supposed to prove that it is fraudulent. Or if they are contending that it is ineligible, they have to prove it as ineligible. Now, how it could be ineligible? The rule further says that may, for reasons to be recorded in writing, not allow debit of any amount, etc., etc. It means before they block this, they have to put it in writing. Again, you should ask for that particular reasons to believe and the reasons which are recorded in writing. Many times, my experience says that you will win the case only on these grounds that there is nothing recorded in writing. So how to counter? First, you can always take this point, which we always also discussed for the previous issue, that there is no legal backing. Only by way of rule, the law cannot operate. Means rules or government cannot supersede the parliament. Firstly, the parliament has to provide for a law, that is a section, and only then a rule can be made to apply that section. This has also been accepted by the Honorable Gujarat High Court in Pelleas India's case. Next. Now, against this contention, there is a common stand taken by the department officers. It is that they are empowered by section 164. And 164 section of the CGST Act and the SGST Act empowers them to make rules. However, let us understand and appreciate this, dear members, that section 164, even though it gives power to make rules, the section is not all envisaging. It means the section is not there to empower them to make rules on each and every aspect of the act. Because if that would have been the case, you would not require any other section empowering the government to make any rule. This one section would have covered all powers of the government. However, that is not the case. If you see anything, if you see registration, if you see valuation, if you see any topic of GST, every section has explicitly given a separate explicit power to the government to make rules relating to valuation, relating to registration, etc. It means that if there is something like blocking of ITC, which is a very sensitive thing, there has to be an express section empowering the government to make the rule. And this generic section 164, which gives powers to the government to make the rules, cannot be applied. Because many times the department takes this contention that yes, we have the power, there is a legal backing in the form of section 164. You can always counter it on this particular point. Then, as I already explained, the most important point is ask for the reasons to believe, and that also should be present in writing. Now, for this, we don't have at present anything in the GST law because this has been firstly used in the GST law. However, we have hundreds of landmark decisions of the income tax law pertaining to section 148 assessment, which is also called as over there income escaping assessment or reassessment. You can always refer those cases and you can use those cases as your defense. Further, reason should be recorded in writing and you have all the rights to ask for those decisions, because that could be your grounds of appeal when you are going at the appellate stage. Now coming to the fourth issue. The fourth issue is that there is some time limit provided in section 16.4. Now the time limit as per this new budget has been extended. Earlier the time limit was up to the due date of filing September month's return or filing of annual return, whichever is earlier. Now the date, that is the due date of September month's return, has been extended up to 30th November by this Finance Act. The Finance Act has been passed. However, these sections all pertain to GST are yet to be notified. But now the basic question over here is, what if you have failed to avail the ITC and the time limit has passed? Now again, this has happened for our initial 3-4 years of GST, where the September due date has passed, or even wherever in the first and the second year the government has extended the date, that has passed, that has lapsed, and later on some ITC was found, maybe at the time of audit, that you identified that, okay, this ITC is yet to be claimed. Can you claim the ITC? Now here, my personal view, if I have to share my understanding, is my personal view, my personal request would be that as far as possible, comply with the 16.4 time limit conditions, even though I personally would be sharing with you my basis of countering this. However, still I will request that you should comply with the time limit issue, because fighting it out on time limit is not a suggestible course of action whenever we are going for litigation. I will not recommend that you go in for this litigation, because it will go a long way. Maybe it will also see the Supreme Court's doors someday. But if you are stuck up, if it is of a past year and you are already stuck up, you can use these pointers that I'm going to discuss whenever you are handling this particular point. Now, the first is in GST law, the basic section putting all the restriction is section 16.2, and section 16.2 starts with the non-obstanted clause, that is notwithstanding. It means that section 16.2 supersedes or overrides all other sections or all other subsections of section 16, including 16.4. Now, what is the point which I want to put over here is, when you read section 16.4, it does not start with a non-obstanted clause, but 16.2 starts with the non-obstanted clause. 16.2 has given all those 8 conditions of availing ITC. Once you have satisfied all those 8 conditions, that is, you are a registered dealer, you have a valid tax invoice, good services have been received, it is also reflected in your 2A, 2B. If all these conditions are satisfied, only the problem is with the time limit, that you forgot to avail it within time and you availed it after the time limit had elapsed. In this particular case, you can always use the first line of defense as that 16.2, which starts with a non-obstanted clause, is overriding all other sections of 16, and hence even the time limit section is overridden by 16.2, which means that once you apply 16.2, you satisfy all the conditions of 16.2, then there is no need to apply any of the other conditions. That is, even if you miss the timeline, you are still eligible. This is the first counter or the first line of defense. Then the second line of defense is, how does 16.1 reads? The first requirement is 16.1, which states that every registered person shall be entitled to take credit of input tax. Now, interestingly, in our earlier excise law, the words used over there were avail SENVAT credit. And if you closely observe, you'll find that the ITC provision of GST has a lot of resemblance to the pre-GST, that is the excise SENVAT credit rules. Now, interestingly, your excise use the word avail SENVAT credit, whereas in section 16.1, the GST law uses the word that every person would be entitled to take credit. Now, there is a big debate between what is the meaning of the word take and what is the meaning of the word avail. I will share my understanding, and this could also be your second line of defense for handling these issues, is that when the law uses the word avail, avail means availing in the returns, that is disclosing in the returns. However, where the law uses the word take, take means taking or showing in your books. Now, if I have shown that particular purchase in my books, it means I have satisfied the conditions of this section, because the section requires that I should take the input tax credit, which I have already taken, where in my books. It is not asking you that you should have availed it within time limit. Once it says that you should have availed it within time limit, then the scenario changes, because availing means availing in the returns. So the second line of defense or the second counter could be that you can always take this defense that the law requires me to take, and I have taken it in my books, which is obviously within timeline because I prepared my books before the close of the year and before the September's due date. Only I failed to avail it in the returns. So still I am complying with the condition. Even section 16.4 uses the word take. So this is your biggest line of defense number 2. There is a difference between taking and availing. Taking is the first stage, which is in your books. Availing is the second stage, which is in your returns. Further, you can always challenge that what is a return under section 39 as required by the law. I agree that after losing in the Honorable Gujarat High Court, after that particular decision of the Honorable Gujarat High Court, the government came up with an amendment saying that 3B is a return, but still that is also challengeable, that whether 3B can be called as return. Next, we have a pre-GST era decision in our favor, where Senvat rate was claimed in the books, but it could not be disclosed in the then returns, which was ST3. Still, in Gulf International Limited, the Honorable Delhi Sestat has said that even though you have disclosed it in your books, but you failed to report it in your returns, still the credit is eligible. So this is a very relevant case to us. You can always use this as a counter. Now, interestingly, so against all these...
So I'll just interrupt. We have some questions also coming up. If you could just attend to them also.
Sir, I'll just complete this point and I'll take the questions. Is it fine, sir?
Fantastic, sir. Fantastic.
Yeah, please.
Fantastic,
sure.
Sir.
Now, when you will be putting all these submissions, the department may come up with a counter saying that in ALD Automotive Private Limited, which is of the Karnataka VAT regime, in that particular decision, the decision is contrary because in that decision, the input credit has been said to be a benefit or a concession, and it is very clearly mentioned in that decision that the credit would be denied on the basis of the time limit condition. Now, if the department uses this particular decision as a counter that, okay, if you are giving me a decision of the Gulf International, I have this decision. Now, the first thing is that this is a decision of VAT era, and GST, ITC is more linked to excise. So you should always follow more excise era decisions for ITC matters rather than the VAT era decisions. First. Second, even if they are quoting this particular decision as a counter to all your submissions, we have a very superb answer. The superb answer is that the Tamil Nadu VAT law, sorry, not Karnataka, the Tamil Nadu VAT law, from where this particular issue has come up, the Tamil Nadu VAT law does not have a similar section like what we have 16.2 and 16.4. We have two separate sections. 16.2 gives all the conditions. 16.4 gives conditions. 16.4 gives a timeline. And most importantly, 16.2, which gives all the conditions, is starting with a non-obstanted clause. It means 16.2 overrides 16.4. This is what is the position of the GST law. However, if you see the Tamil Nadu VAT law to which this particular decision pertains, in Tamil Nadu VAT law, there is one single section which gives all the conditions, including the timeline. So it is like in the language of GST law, in section 16.2 itself, if they were to have put the timeline condition, then it would have become a relevant condition for allowing or disallowing ITC. But since they have put it in section 16.4 and 16.2 overrides 16.4, this is what is our primary contention. So you can always counter this submission of the department also stating that 2 pointers. One, GST ITC is more based on the excise and VAT. So you should apply those decisions and not VAT decisions, especially VAT laws were different in each state. Second, if they are applying this particular case, then you can always counter this saying that the Tamil Nadu VAT law is very different from the GST in the sense that in GST 16.2, 16.4 are separate sections. The 16.4, that is a time limit condition, is given separately, and 16.2 overrides 16.4. However, in the Tamil Nadu VAT law, all the conditions, including the time limit conditions, are given in the main section. So over there, following the time limit condition is inevitable, but in GST law, that is not the case. Fine. So after discussing this now, as sir has suggested, let me take up the points in chat box. Sir, I have to refer the chat box, correct?
Exactly, sir. Please go ahead, sir.
So I think, sir, there are two points which I think both have come from your side only.
No, sir. This is coming from the viewers, which I'm just typing.
You are posting me here. Okay.
Exactly.
So the first one is misuse of ITC and tightening of rules and regulations by the regulators. Sir, I didn't get the question. I think this is only a view, I think, shared by some of the participants. Misuse of ITC.
You can go ahead, sir. It's not a problem. Please, you can go ahead, sir.
Okay. Second one is, should a CA be whistleblower? Okay. Impact on ethics towards client. Is it wrong if weightage to macroeconomic factors is not considered in ECL model? Okay, fine. I would just like to share my view. See, whether a CA has to be whistleblower or not, 100% I believe, yes, you have to be whistleblower. But sir, whoever's question or this particular submission is, sir, anyways, I'm always on the side of the law. Like as somebody also said that whether or not we have to see the macroeconomic factors, definitely yes. But I would like to put a simple pointer, sir, whoever's point that is that what is our responsibility as a CA? Sir, our equal responsibility is to also bring out the lacunas in the law and also to defend whoever it is, whether it be government or whether it be society, against something which is not correct in the law. So if the law is incorrect or if the law is incorrectly implemented by the department, then definitely it is our role only as CAs to bring these wrongdoings to light. Next point is, I am paying rent to mall. The landlord has not filed GST return nor has paid GST tax for past 2 years. I did not take input credit. Now the landlord has paid and filed returns for past 2 years. How can I take input now when limit is over? Okay. What if the same is removed from portal by GST once time limit 16.4 expires? Fine. ITC won't get reflected in 2A2B once 16.4 time limit expires. Fine, sir. And now see, this is what I'm saying. This is where you as a CA only has to come up and guide your clients. So answering your question straight, if your landlord did not pay tax, now let me put this point. This is an interesting point raised by you. Thank you for this point. Who is having the time limit, the September return time limit? Is it on the supplier to pay the tax or is it on the recipient to avail the credit? The law has put the time limit on the recipient. What do I mean by this? I'm also handling a similar case of a very big company. In that particular case, the same thing has happened, that the supplier initially did not pay tax. So it was not appearing in the 2A, 2B of the recipient. And using the provisions, whatever we are discussing, the consultant of the recipient decided, sir, you should not avail credit because it is not reflecting in your 2A, 2B. And unfortunately, the 16.4 time limit expired. And later on in this amnesty scheme, which was brought during the COVID period, the supplier filed the returns and also paid the tax. Now the problem is, since my timeline as a recipient has expired, what are my options open? But firstly, before I answer this, let me first highlight this point. The time limit of 16.4 is on the recipient, not on the supplier. Means if this same thing happens again, that your supplier has not filed return or has not paid tax till your time limit of September comes, like for this year, by the time of September, even if your supplier has not filed his returns or not paid the tax, sir, you go ahead and take the credit. Why? First, as I said, reflection on 2A, 2B is not compulsory till 1st of Jan 2022. So if the matter is pertaining to period prior to 1st of Jan 2022, reflection in 2A, 2B is anyways not compulsory. Second, if the supplier pays the tax tomorrow late, like what is happening in your question and what the case we are handling, you will be deprived of availing the credit. So best is you avail the credit, you just don't utilize it. Whenever in future the supplier will pay the tax, you will be eligible for the ITC on the simple grounds that you took the credit in the time limit and the requirement is supplier should have paid tax. Section 16.2 nowhere says supplier should have paid tax within the time limit. So this time limit is not for the supplier to pay the tax. So even if he has paid the tax post the September timeline, but if you avail the credit, you will always be in the right position. Now, coming to your particular case, you also did not avail the credit. I personally believe, sir, if you don't want to contest, then just forgo the credit because it is going to be litigative. But yes, if the amount involved is huge and you are ready to contest, sir, go ahead, take the credit. The only thing is that you'll have to fight it out in the court of law. Go ahead, take the credit. Just don't utilize it so that at least the interest burden is not there. Tomorrow, if they come up with you asking for reversal, you reverse it under protest and go in for appeals. this is what is my humble submission to your question, that what you should do, you should definitely avail the credit, but be prepared for litigation. Salim sir, I hope I have answered all the questions.
Yes, sir. And thank you so much, because we also have our vice chairman, sir, waiting over here. So before we move ahead, Vishal sir, thank you so much. And I'm very fascinated when I was seeing your slide, the bottom right, where you have a trademark, a student of GST. Yeah. So this is really nice and really very fascinating and something very innovative I've come across. Yeah. So thank you so much. Really enlightening session from your end. And I really wholeheartedly thank you from the bottom of the heart, and from the entire fraternity, and from the CPE community. We also have CA Gyan Chandra Mishra, who is Vice Chairman of CPE Committee. He is a fellow member of ICI, associate member of ICSI, a law graduate, and an insolvency professional. He's serving the institute since 2010, which is really a long period, more than a decade. Presently, he is a Central Council member and he is Vice Chairman of CPE, as I suggested. He is into Internal Audit Standards Board and Committee on Management Accounting. He is also a member of Examination Committee. He possesses 24 years of proven professional track record and has been instrumental in contributing towards the cause of social welfare. He has been served as a speaker, resource person at various forums, and has delivered lectures on various topics. So on to you, CA Gyan Mishra, sir. Sir, please enlighten us.
Welcome, sir. Welcome, sir.
Thank you, very respected Salim ji, moderator of this session. Very distinguished speakers of today's session, Vishal ji, and of course,
So we also have Venkata sir also over here.
Yeah, that's why I'm recognizing him. And Venkata sir, and of course the officers of the CPE committee who have been instrumental in organizing this program, and the attendees of the program. Good evening to all of you. Friends, it's really a matter of pride for the CPE committee that we could arrange such a wonderful program under aegis of the committee. ITC has been a subject matter of litigation for quite some time. And especially we see for the last 1.5 years, we will witness that a lot of bills, the input credit being taken by the business organizations and entities that are not being through. And moreover, I will surely say that the input credit being undertaken by some entities which have been proved as being the fake invoice by the department. I hope all these discussions must have been taken place during the discussion of this CPE meeting. As far as regarding the input rate of the bills which have crossed certain time that is being taken, I was just witnessing that Vishal Bhai has taken the things very nicely and delivered the things regarding the input rates which have undergone certain time limit. So friends, this is the time for the professional to update themselves according to the rules and regulations in the changing scenario. But I'm sure that in coming time, a lot of litigations on which the judicial pronouncements needed in this area, because a lot of associates who are really of the original and real owner of the invoices, they are not been getting the credit of the invoices. So I hope that these things will be taken care of by the judicial pronouncements in coming time. I will not take much time as our honorable speakers have deliberated a lot on the topic. I am just happy that this session has ended well by a remarkable learning for the members at large. And I'm thankful to the committee members for inviting me in the program. Once again, I'm thankful to Salim ji for such a nice moderation of the program. Thank you once again to all the participants for joining the program, and to all the officers of ICI for such wonderful program, and of course to both the speakers for wonderful deliberation in the interest of the profession. Thank you once again.